over that period.
William, so let's talk about 2021. So BlueBox is 31.58% for the year against BlackRock and your competitors, 8% Polar, I think 10.2, iShares 29.5%, ARC down 23.38. So why was it such a strong year for BlueBox?
Yes, so I think a couple of factors. So the first one is that the COVID crisis, which gave us an enormous boost, and everyone else in tech in 2020, as people were stuck at home and used technology a lot more, accelerated a lot of business cases and brought those forward. So making tech companies more valuable by bringing the good news closer, as it were. And that continued in 2021 to a degree. So everyone worried that it might reverse, but in fact, if anything, probably it continued, although not quite at the same rate. So there was more use of technology in all sorts of aspects of our lives. That's good for us, because every time someone uses technology, they use stuff which is made by one of our companies, provided by one of our companies. Another factor was that towards the end, or in August 2020, so towards the end of 2020, we took the decision we no longer wanted to invest in any Chinese stocks. So we sold our only Chinese position, and we stayed completely out of China since then, and probably will do for the foreseeable future. And that was pretty well timed. So for exactly the reason we thought, that the Chinese government was basically going to start throwing its weight around and telling companies what to do, and essentially take control of the tech companies to a degree. That's what happened. So a lot of the Chinese stocks underperformed dramatically through 2021. We didn't own any, so that was great. And another factor is that the really exciting disruptive companies that are using technology in all sorts of exciting ways in different industries did very badly from February last year. So they've been doing badly for 12 months now. And I'll pop a chart up on the screen. So hold on a second, and I will get this up. So this is basically looking at two different funds. One of the blue one is us, so the BlueBox Tech Fund, that's enablers, and the red one is the ARC Innovation Active ETF. So this is the world's biggest active ETF, and it's focused entirely on disruptive companies. And very few of these are tech companies, so only about 10-12% of the fund is actually in stocks that are classified as technology, selling technology. All the rest of them are selling healthcare, industrials, or consumer products, and they're using technology to disrupt those industries. And most of them, on average, don't make a profit. So the PE overall of the ARC fund is negative. So in other words, on the average company is making a loss. So the red line are profitless disruptors, but they're very exciting and growing very fast. And you can see that the red line had a fantastic 2020. We both had a good 2020. They had an amazing 2020. With a very high correlation between the two funds. They basically sort of had a beta of 2 to us. But that correlation completely broke down a year ago. So in February 2021, you can see that the red line, ARC, the disruptors, peaked and then has been trending down ever since, pretty dramatically recently. But it was trending down through the whole of 2020 while we were continuing to trend up. So the blue line is continuing to head upwards, not at the 60% rate of 2020, naturally, but sort of more at 25-30% rate. Still unsustainable, but keeping it going for a while. So the enablers continue to trend up, but the disruptors tend to trade down. That's great from our point of view in 2021, because we don't have much in the disruptor space and we got lots of enablers. So that's why we were outperforming through that year. But then what has happened this year in January is I think people have simply noticed what's happened to those disruptors. And there are all sorts of other factors in Ukraine, interest rates, all that sort of stuff. But one of the things is that people have just suddenly noticed how badly those profitless disruptors have been doing, or had been doing, for the past 11 months, and panicked and thought, these are tech companies, they're all going down, let's sell tech companies. So that actually knocked the enablers. You can see that we had a pretty tough January. So we were down 13%, I think, on the month, our worst month so far since launch, dragged down by people's fear of technology, not realizing that those profitless companies in the disruptor funds are not tech companies. The vast majority of the companies buying technology, making lots of money for our businesses on the way through, but losing money themselves. And that will come back. So we will bounce back from that because our companies have a value. They are extremely profitable businesses. And that profit belongs to the shareholders. So at some point, you get a floor to the valuation. It looks as though that has probably turned and they're coming back now. Whereas there is no particular floor for a company that has no profits and no hope of ever being profitable. So there's no reason why the disruptors will ever turn up at a certain point. Some point they will, maybe not this group of disruptors, but a group of profitless disruptors will excite the market again and start going up sharply. But you can't tell when it's going to happen. And my guess is that that group actually continued to trend down for a while. I might be wrong, but then again, I might not. So we've had a tough January, but everybody else has had an even tougher January. So for a certain point of view, I'm quite happy with that because it's really shaken out what's going on. But that's essentially why we outperformed last year. So COVID was continuing, the beneficial effect on tech companies in general. Chinese stocks were plummeting and we didn't own any, and profitless disruptors were trending down all year. And again, we don't own any of those, whereas our stocks were having quite a nice time trending upwards. So long answer to your question.
And I think you've sort of jumped into my next question and really
Sorry.
jumping into January. Yeah, so I think that's sort of the big question here. I think a lot of investors at the moment, January is the worst month since since 2008, isn't it? I think in terms of the downside, or even the pandemic,
yeah.
It's been less. But are we at the end? I mean, I saw as of last Friday, BlueBox stocks, your top 10 holdings have all jumped up. Do you see that continuing, or where do you see that going?
Well, at some point they'll continue back upwards. So I don't know if you've all read my commentary. I'm sure everybody has read my commentary in the entire world, both from December, which sort of summarized the year of 2021, and then I put out a little sort of mid-month commentary, I think on around the 7th of January, just talking about what was going on, because it was clear that January was going to be a tough month. And in both cases, I was saying, do not think that the last year is typical for tech. It's been extraordinary. Everything's just, for our sort of companies, those enablers, everything's just gone up and to the right. I mean, at the end of the year, looking back, we'd only had one down month in the previous 15, two in almost 2 years. I mean, that's just not sustainable. You cannot have the tech sector just going up every month, month after month after month, for year after year. It's a sector that's got volatility. You will have down 10% months, and we hadn't had one for a long time. So in both cases said, you must expect volatility, but the trend remains upwards. So the trend is driven by this direct connection of systems to the real world, which has unlocked all sorts of stuff that was impossible 20 years ago. Because human beings were still in the loop. Human beings were putting the information into the system and reading the results of whatever the computer was doing and then acting on the world. And those human beings slowed the system down so much that there were limits to what you could do with computers and computing power. By directly connecting those systems to the real world, so that they read one very limited aspect of the world themselves directly without a human being with a keyboard, and then the computers, the systems directly change the world without having to refer to a human being for permission or to do it for them. Suddenly that block, the human in the loop, is removed and systems run millions of times faster. So this enables all sorts of stuff that was simply impossible 20 years ago. And over the last 15 years, so from the 2005 onwards, this momentum has been building up where more and more is possible. And every time you have a new application that's enabled by direct connection, it can enable a range of further applications. Then that one can enable further applications again. So you get waves of this release of potential again and again and again. It takes decades to work its way through the system. And there is absolutely no sign that I can see that is slowing down. So it's just going ahead, full steam ahead. So the trend for technology is still fantastic, because what is happening is technology is essentially taking the growth out of every other sector, because in every other sector, every company is having to invest all the money it can in technology or get left behind and die. So they're all spending their excess returns, that profits, on technology. And if you don't reinvest your excess returns in your own business, you don't grow. And so all these non-tech industries are having to invest all their excess returns in technology. So the only bit of the market that can grow is technology. And that's why technology has dominated the growth of profits for the last 15 years. And in my view, will continue to do so. So that gives a great trend, a background for tech. But you'll have volatility around that trend. So we were probably over that trend, at the end of the year. Maybe we're now under that trend. Maybe we're on the trend, but the trend will continue, in my view, in the mid to high teens for this sort of strategy for the foreseeable future. So that gives us confidence to buy the dips, as it were. So we don't panic when we have a difficult month like January, because what we own has a fundamental value. If we own stuff like profitless disruptors, we would panic because there's no reason that they'll ever come back, those individual stocks. They may just disappear. What we have, the businesses we own, have real value. Yeah, some have good months, some have bad months. On balance, they all had fantastic, almost all had fantastic December quarters. So the fundamentals are great. And that means in time, those stocks will come back. You just need to be patient. And what we are then doing is rebalancing between the short-term winners and the short-term losers, just shuffling money between the two, so that we're always tending to be adding to the stocks that have done a little bit less well, and we're taking a little bit out of the ones that have done really well. And that adds quite a lot of value over time. I can't remember what the question was, but I probably wandered way off it by now.
In your commentary, I think it'd be quite good to bring up the, you had that log chart, 15.2% growth.
Yeah.
Where are we in that line?
So I'll pop that up.
A lot of investors in here have invested, so a lot of the advisors invested their clients' money. So it's really a case of, we were very much sold on that 50% growth, and is that still the case? Even with the dip, I believe, we're back down. Are we coming back into that line, or is it still remaining above?
Right, I'm not quite sure why it's. Oh, hang on. Right, okay. So that's the one you were talking about. So this is the equal weighted version of the S&P Technology Index. So this is the average US tech stock. The reason we're using an equal weighted rather than a market cap weighted graph here is because the mega caps are so huge in the tech sector, they distort the market cap weighted indices that we use. They create a lot of volatility. This is the average US tech stock, and it's on a log chart on the right. So these red lines are basically a 15.2% growth all the way along. So what this chart is saying is that the average US tech stock has basically grown its stock price by 15% a year, every year since 2009, without fail. And then in 2020, it spent all of 2020 going down to the bottom of the range and then popping back up. And it only actually got out of the top of that range in November. So right at the end of 2020, despite all that magnificent performance, because a 15% trend, if you go down and you're in a 15% trend, you have a lot of catching up to do to get back to where you were before. But from the end of 2020 and into early 2021, we moved out of that range and into a new one. And I think what's happening is I'm not proposing that the trend is now like that, because I just don't think that's sustainable. But what I think is we've had a one-off boost from COVID, and now we continue that 15% a year trend into the future over here. And where the bottom and the top of that new trend are, I don't know. But it seems to me that's what's going on here. And so that's January coming down. As you can see, it's taken us down to almost into the top of the old trend, but I don't think this red line really means anything now. So I think that the trend continues up and to the right for a long time to come because of all this innovation, all these potential new activities and uses of technology unleashed by direct connection, and where exactly the boundaries of that new version of the trend line are, we don't yet know, but the slope I would have thought is the same. And if the whole industry is going up by 15% a year and we're any good at our job at all, we should be able to beat that a bit, which is why we feel that we can sustain this mid to high teens annualized net return that we've achieved over the last 10 plus years. So that sort of 10 plus year from when I was running at BlackRock, essentially the same strategy, and the almost 4 years we've had at BlueBox. If you consider that to be one continuous performance, then that's generated consistently between 14 and 20% a year annualized after fees over 10 years throughout that period. So I think we continue that mid to high teens annualized performance for the fund after fees if the industry is continuing at 15% or so forever. Not forever, but for a decade or two, I would have thought.
So that graph is very, very small. So hopefully people can see the top.
Yeah, I was a bit in my commentary. I was a little bit cheeky at the very end and said you can see the downturn, but you might need a magnifying glass. That's not the case now. Okay, anybody could see that it's dipped now, but it's still nothing compared to the moves we've seen in the past. So it could get worse. I'm not saying it's ended. That might not be the bottom. Maybe it's going to go way lower. I don't think so. It doesn't feel like it. It feels now as if it's finding a floor, but I could well be wrong.
I suppose a good question to ask is, Jupiter Merler and big investor. I see a lot of the subs, and I see all the subs and reds that come in and out. We haven't really seen any redemptions. And I think from investors, they are still very confident. People are buying on the dip and money still going in. So what are Jupiter's comments? Are they concerned, or they obviously they're long-term?
No, they actually haven't, and usually they've been quite quiet. So we chat fairly constantly, and they haven't been asking any. I think hopefully my commentary answered any questions they might have had. They're happy with our strategy as long as we continue to do what we say we're doing. Then, unless there's some catastrophe out there, I think they'll stick with us. So we just need to keep answering the questions in the same way, not doing anything which is obviously different from what we said we'll do. As you say, the fund has basically been continuing to receive inflows, but a few outflows. The outflows have been tiny, and the inflows have continued to be big. So the sort of net flows have been distinctly positive. I haven't seen any deceleration at all, actually, to be honest. The AUM of the fund has been dragged down by the performance of the market. So we did very briefly touch 1.1 billion. We just got over that, just enough to sort of book it, as it were. And then a few days ago, I think it probably was Thursday night, we got down to about $100,000 below 900 million. So that was a $200 million move. And that was entirely market movement. So there was no AUM coming out from that. There was net addition of AUM between the two. And now we're back up nearer 900 again, and nearer $1 billion again.
$1 billion, yeah. So we're going back through. So yeah, on to that question, size of AUM. So, congratulations to both me and you, everyone.
Thank you, Simon.
Hopefully I've made a little bit of a dent in that AUM.
Yep. I'm the biggest fundraiser there for the fund so far. Yeah.
So in terms of growth behind the portfolio, so do you expect to hit the 2-3 billion mark this year?
Be lovely, but who knows? We've got some quite big potential investors in the pipeline, and at some point one of them will put some money in. So hopefully we'll get a big chunk coming in at some time. But the really big investors often take a very long time to make their minds up and then process it and check everything and stuff. So and you don't know for sure it's going to arrive until the day it actually arrives. So I can see where lots more money can come from, which is actually going to arrive when I have absolutely no idea. But the direction of movement is great.
Well, as we mean, I think the sort of the biggest inflows and constant inflows are from the likes of wealth managers. The discretionary stuff is slow, but should be growing. But second part of today, and we do have a question, so that sort of leads on to what we're going to talk about next, is portfolio changes. So obviously your strategy is to not change your positions a couple of years. So is there any changes in the portfolio? You're very heavily weighted towards semiconductors, I think 40% maximum exposure you have. Are you reducing that? Is it time to sort of take that down? Are there any, so if you could explain any big changes?
Okay, so the strategy will always have a lot of semiconductors compared to our competitors and compared to whatever benchmark you look at. So just because semiconductors are at the heart of everything in technology, they're not trusted by investors, so they tend to be undervalued in my view in many cases. And they are taking a bigger share of the value of the world, or of technology, and technology is taking a bigger share of the value of the world. So semis are on the fantastic trend. You just got to buy the right ones. And the big chunks of semiconductor industry we're not interested in, memory, for example. And there are some quite big chunks of the industry which we're very interested in, analog, semiconductor equipment. And we'll always be overexposed to that group compared to anybody else. But that weight will vary. So it will vary from, say, 20% if we're quite bearish on semiconductors. We really think the semiconductor cycle is about to fall off a cliff, or is already falling off a cliff, up to around 40%, which is maximum bullish for us. World's biggest semiconductor shortage in history. That's where we are now, because we are in the middle of the world's biggest semiconductor shortage in history, and it's nowhere near clearing. So anybody who thinks the semiconductor shortage is about to be solved is basically has no idea how the industry works. We're nowhere near that yet. So we're up at the top of that. And my job at the moment is to stop that number getting above 40%, because we don't want to have more than 40% semiconductors in the fund, because we are a tech fund, we're not a semiconductor fund. So as it were, I've set myself or ourselves a limit of 40. And so in about the middle of January, although the semiconductor stocks and semiconductor equipment companies, the ones that make the equipment to sell semis, although they were down, actually they weren't down as much as some of the software names and some of the other stuff, which was nearer to the profitless disruptors that were being affected by, they were being affected by worries over ARC and the like. So in fact, some of those software names were doing worse And the semi equipment names had an amazing run late last year. So I actually took some money out of those semiconductor names, just took them back down to target weight to bring the total, because the total was, I think it got up to about 42%, something of that sort in semi. So I brought that down to, let's say, 39 to get it back under the 40 again, and put those profits from the semis into the lagging software names, some of which were really very solid companies, Adobe, Intuit. These are good businesses, and no one thinks they're going to go away. Incredibly profitable. And that actually turned out to be quite well timed, because the next thing that fell off the cliff were the semi stocks. Everybody started panicking about them, so they underperformed, and the software names relatively bounced. So it wasn't a big move, maybe a move 4% of the fund, something of that sort. But it was luckily a move that was in the right direction. But nothing big, so we haven't changed any names for a while. There are a few names we're looking at. So Rupert, my co-manager, and I are looking very hard at a number of stocks at the moment, and we've got a list of potential new buys. But to be honest, it's very difficult to find a company that we can like more than we got at the moment. So we're not in any hurry. When we buy a new stock, we will have thought about it for quite a long time. But we haven't made any big changes recently, no.
So you sort of led on to another question there from someone in the audience. So Alex has said, how big is your universe of stocks, that you consider in the portfolio? So do you have a huge amount of names, or watching your shortlist? I can imagine direct connection is quite limiting in terms of, you can't just pick up and coming stocks and things that are coming out. So how big is that?
Yeah, good question, Alex. So the theoretical universe that we could invest in, tech stocks above a certain market cap is probably about 400, something of that sort in the world. Of those, 300 we would never even think about, just not our sort of companies. So you're left with maybe 100. Probably 2/3 of those are potentially really interested. So we're down to the sort of 60s now, and we own 30 something. So we own about half of the stocks where we could, in my view, own. To be honest, it really is quite hard to find new ones. So it's realistically, there's probably 60, 70, maybe more companies where they're not an immediate discard because they just have got completely the wrong P&L or something of that sort. Or all the values going to the employees or management, and we own half of those names, and we hope the better half of those names. And really, what we're looking for, we're essentially looking for companies that are doing something that's really useful, that's becoming increasingly useful over time, and no one else can do it anything like as well. And if it's a bit boring, then even better, because we won't have to overpay for it, because people don't like boring stocks in tech. They're just not interested in boring stocks. And the thing is, those companies don't change very much. Sort of by definition, they don't change very much. They've got huge barriers to entry. No one else can replace them. They don't tend to fall out of favor. So it's an area of the market where, despite the fact it's technology, there isn't a lot of things move very, very slowly. And so you can keep track of them.
Thank you, William. And yeah, so just a quick question, liquidity. So someone just asked, how liquid are your holdings? So, I think you don't have any small caps.
Yep. So we don't do anything below $1 billion, and we don't do very much below $10 billion in market caps. And we got one stock which is at $9 billion at the moment, Epam Systems, and that's an enormous company. I mean, a $9-10 billion market cap company is absolutely vast. And tech is a very liquid sector. These things trade a lot, and also interestingly, the liquidity tends to rise in a crisis, not fall. So look at March 2020. The liquidity of US tech stocks soared, even though stock prices were going down. You could get rid of as much as you like, as quickly. You wouldn't get a good price for it. You wouldn't get what you thought you were going to get a month ago, but you could get rid of the whole lot overnight if you wanted to. So the liquidity of these stocks is not a problem. So we've had to put in, I think the most we've had to put in a single day was $227 million, and it all went in a few minutes, basically, almost all of it within a half an hour, apart from the Asian stocks, which all went in at the open the next day. So these are really liquid names we've got here.
I saw you had this question before. I think liquidity gets to an issue.
Yeah.
7 billion plus, so we're far away from there. So
potentially somewhere between 7 and 10 is my guess. Just looking at my friends running tech funds, their experience where they ran into issues, and they tend to have much higher turnover than our strategy does.
Brilliant. Let's hope it's 10.
Let's hope it's 10.
And
let's hope we get to find out. That's the important thing.
So a question from Michelle: do you think the market has turned now, given the volatility of January?
Yeah, as I said earlier, I hesitate to call the market, but it feels better. So there was an attempt to turn about 10 days ago where we had a couple of very strong up days, but it felt wobbly. There was a lot of volatility. You got huge reversals midday and stuff, and it sort of fought its way up in the end, but it was not convincing. The last few days have been more convincing because it's basically just been up. So during the day, things have tended to get a little bit better each day, and then you've had an even stronger day the next day. Then yesterday, the market tried to go down a bit, and then it was up by the end, and then there was a sharp rise at the end of the day. That feels good to me. But I'm not a trader. I'm a long-term investor. I'm basically the minimum unit for me is a quarter, and really it's about 3 years. So a week, a month, it's just something to be lived through and make sure you come out the other side. And the nice thing is it's doing more damage to everybody else than it is to me. So yeah, we just live through it.
Well, I think if afterwards we will share. We've done a peer group analysis running up to the end of February.
And January.
End of January. So, figures have come out very well. So I think people are doing very well.
It's slightly embarrassing for the in my general presentation, I said at the beginning, most tech funds underperform most indices in most years, and unfortunately, it's the perfect demonstration. We track on a regular basis 16 active tech funds and 1 passive one. So iShares Global Technology, probably the best, most liquid global passive fund. And the embarrassing thing is, over the last 3 years, only 1 fund has beaten iShares. From the tech sector. I said 1 active fund of the 16 we track. It happens to be ours, so we're quite proud of that. And a couple of the other ones have come very close. So but we're not beating the active as an industry. We're not beating the passive funds, and I'm afraid that's what happens if people don't know what they're doing. And most tech investors, to be frank, don't know what they're doing. They're buying junk, always junk after junk after junk, and then they're surprised it doesn't outperform. What we're doing is just buying what every traditional investor does in every other sector. We're buying good companies that make lots of money and where those profits will grow year after year after year. And amazingly, that's a formula which beats the index over multiple year periods. But there's no one else trying to do it.
Yeah, brilliant. So just checking this in. So is there any stocks in the funds? So this is leading on to my next part, which I'm talking about exciting things in the industry. So one thing I hear about a lot is the metaverse, William. So I know you're going to tell me I do not care about the metaverse. Too exciting. Don't want to hear about it. But clients that they speak to advisors and they say, I want to be part of it. What is this metaverse? And it's going to become a big thing. I think it is. I mean, you look at children and all this. They're the up and coming ones, and they're so plugged into Fortnite and all these different games. So their experience is a lot different from ours. So I think the next 10 years is going to look very different. So the metaverse, as Facebook's changed their name, what stocks within your portfolio would you say benefit from the likes of the metaverse? What are things that
So first, I'll start by saying that companies only change their name when something's going wrong. So that's I don't know of any company that changed its name when things were going well. So it's because it's a distraction technique. I'll just leave it at that. Not making any comments on meta platforms, but it's got a new name. So the metaverse is not a new concept. So the term was coined in a book called Snow Crash, which I reread recently, and it's an extraordinary book. It was written in 1992, and when you're reading it, you have to remember what 1992 was like in terms of computers. Everything was plugged into the wall. You didn't have LCDs; you had big CRT screens, and what they're talking about, no one had thought of Second Life and sort of virtual platforms. The internet barely existed. And yet what he's describing in this is a world where everyone can live in 2 parallel worlds at the same time. And it's not quite clear whether you're wearing spectacles or contact lenses or something of that sort, but you can flick in between the real world and the virtual world, the metaverse, whenever you like. And when you're in one, you can't see the other. So that's the danger here. So that it's a virtual reality rather than an augmented reality. But that's the concept. And I think the concept is the metaverse is that all these games and online platforms, social networks, banking platforms are all united in a single metaverse. And you can log on to that, as it were, and do everything you want to do in an alternative parallel world. That's essentially what Snow Crash was talking about. And that would be the metaverse. What you've got at the moment is hundreds of potential metaverses because there's no effort to link any of them together. And that really is pretty much what everyone had a year ago. And it's pretty much what everyone will have in 1 year's time. So you go and play Call of Duty and you can't wander from Call of Duty into World of Warcraft. And you certainly can't walk into your bank and transfer money around. And you probably can't log into Facebook while you're playing Call of Duty as well. You'd be shot if you did. So at the moment, there is more than one metaverse. There's hundreds, if not thousands of them. And until they're linked together into a single seamless platform, I don't really see it can unlock the potential that people are talking about. And as Simon said, I don't really care. Because whoever it is who's building all these competing platforms, and the more competition that's going on, the better in my view, because the more building is going on. Every single one of these platforms requires buying a lot of stuff from my companies: hardware, software, semiconductors, networking equipment, IT services. That's what my companies sell them. None of my companies sell you the metaverse. They sell the bits for other people to make the metaverse with, and that's very, very lucrative. Whereas no one's going to make any money from the metaverse for decades. The amount of money Google's pouring into it at the moment to try and catch up, most of that money is ending up in the pockets of companies like the ones we own.
Yeah. I think Microsoft just bought Activision. I suppose they're part of Metaverse as well. So we've got a question here. So what's your view on technology funds that hold disruptive technology, which have a disruptive technology strategy? So do you think they will change their strategy? Looking at BlueBox.
No, they can't. They can't, because they're trapped in it. And some of them, I'm not saying you can't make money with disruptors. So you can either have a really good year, like Cathy Wood at ARC did in 2020, and then get out, or you can be consistently buying the new disruptive stories when they're very new and selling them before they get tired, because the next one is coming along that's going to make them obsolete. But in order to do that, you have to be incredibly well plugged in. You have to be physically located in Silicon Valley. You have to have the right network. You have to be absolutely on the ball the whole time. And you have to keep turning your portfolio over, which is expensive. And that's one thing when you trade, you don't know whether it's going to win or not. The only thing you know for certain is that trade will cost your customer money, your clients money. So you don't want to do as much more than you have to. But if you're buying disruptors, you have to be constantly turning that portfolio over, because those companies don't make any money and then they die. So you have to sell them on before anybody realizes what's going to kill them. But there are people who make a good living. There are some tech funds which do extremely well from that over the long run. But even they were carried out in January, because it didn't matter if you had the right disruptors, the ones that were still valid and not about to be blown out of the water by someone else, because all of them went down. And all of them have been trending down for a year now. So that type of fund has had a very difficult year. So you can do it. And there are some funds that do it very well, but there are times where it just doesn't work, because the market realizes that actually all these companies are worth nothing. And so it doesn't matter if you own the ones that are going to be worth something in theory for longer, as it were, because the market says actually there are no profits. That's not a business, is it? That's a charity. So I'm not going to attribute any value to it.
Yeah, I think with the other tech funds out there, like you said, you buy them, might have a fantastic year and might outperform BlueBox, but it's when it drops down, they're going to be losing, as it's happening at the moment. They're going to be losing a lot more. So if you want a fund like yours, which is more of a steady growth, then I think that this is the
that's steady plus 63% in 2020. That's steady growth. The extraordinary thing is, my fund, in theory, everyone would expect it to underperform in the really dramatic years like 2020 or 2017, but it doesn't. It comes out right at the top of the pack. So despite the fact we own the boring companies, not the massive outperformers that hit every headline, everybody thinks, why didn't I own that? We don't own any of them. We're just not interested in those stocks. And yet we can still perform in the top quartile of funds in a year like 2020 and 2017. 2017, my final year running the fund at BlackRock ended in March 2017. An amazing period for tech. And tech as a whole was up 40% I think it was. And this strategy that I was running with boring stuff in it was the best performing offshore tech fund in the world for that year. Just owning the boring stuff. Didn't own any of the big winners at that point. Just don't own the big losers. That's the main point. You don't want to own any of the disruptors as they're on the way down. The easiest thing is just not to own them at all, because they're all doomed to go down one day.
Yeah. So a question here. So I mentioned Fortnite and the game sector. So with Microsoft buying Activision, how do you feel it will impact Microsoft and the industry?
Yeah, and Sony's now announced that it's buying Bungie, so another games company. So consolidation is suddenly happening, and Activision wouldn't have allowed itself to sell unless it had trouble. It's had a very troubled year. We've owned it, so it was our biggest detractor, I think, last year. And the CEO, Bobby Kotick, would not have sold that business unless he'd simply got bored of the whole thing. So, and I think that's unlocked a wave of deal making now in the sector. So how will it affect Microsoft? So it's the biggest acquisition Microsoft's made. The second biggest was LinkedIn in 2016. And this one makes a lot more sense. I mean, LinkedIn was massively overvalued. They haven't really done anything. They haven't destroyed it. LinkedIn looks exactly the same as it was in 2016, probably a bit more advertising, that's it. So they haven't changed that business, probably a good thing, but it's difficult to see why they paid such a huge premium for it and what they thought they were getting out of it. With Activision, it's much clearer. They're getting this at a bargain. So they've essentially paid the acquisition price is pretty much where the stock price was a year ago before it had a very difficult year. So they haven't had to pay a premium on a business that's still worth a lot of money. As long as they can manage this huge sprawling network of development studios, which is what EA and Activision both consist of. So lots and lots of semi-independent studios producing games, certain franchises, and you might have 2 or 3 studios working on alternate versions of the same franchise. So this year's Call of Duty is from one studio, and then next year's is from the one after, and etc. That takes really good management, and that's been the strength of Activision over the years, that it's been incredibly well managed, and those games have not been announced until they are definitely ready to come out or at a certain date, and then they've come out on that date, and that's been very distinct from everybody else in the games publishing market. And that's what broke down last year. That's what really, in the end, got us to sell Activision a couple of months before Microsoft bought it. It'd be nice if we'd held on for Microsoft, but we thought we couldn't own it because the reason for owning it was no longer there. So can Microsoft regain control of what is now an even bigger, more sprawling empire, because it has its own, game sales, got Xbox and various elements related to that. So it's an even bigger empire for it to manage. But Microsoft's a very, very well-run business. So I suspect if anyone can do it, they can. You can see there's a logic to it. I think the regulators may let it happen. Then again, may not, but they may. We'll see. They probably have to divest something, I would have thought. So there's going to be a bit of administrative headache, but Microsoft's got the management capability to deal with sort of stuff. It's not going to change the course of the business as a whole.
Another question here, William. So I understand that you buy the enablers and you like semiconductors. So how, if you do you cluster the sorts of enabling technologies? So I think that's more to do with how you pick in your stocks in terms of classification of enablers versus disruptors.
Yeah. Okay. So so I think what you're saying is sort of that do we group them into different themes or in some sort of enabling themes rather than disruptive themes? I suppose we probably, yes. Okay, so I think we probably do. So for example, analog semiconductors, it's a fairly obvious classification, and it's a group of companies that most people overlook because they're pretty boring. They're making very small, very cheap analog chips that can be 5 or 6 cents each, something of that sort. And there are hundreds of them. Any electronic gadget you pick up has got literally hundreds of these analog semiconductors, and they're so small you can hardly see them. So 20 years ago, when I started doing this, these were the things that looked like sort of multicolored zebras grazing on your circuit board. Now they're so small that they're pinhead size. How they get them the right way up, I have no idea, but that's not my problem. So these analog chips, this is a big group, and essentially they're the translation between the digital world of the computer and the real analog world that we live in. And if you've got a computer that's interacting with the real world, there must be at least one analog chip on the input and one on the output, or it couldn't do it. It just wouldn't understand it either. And of course, if direct connection is becoming more important, therefore you need more analog, and you need hundreds or thousands of these chips. And that's what's taken this group of companies from a fairly obscure bit of the semiconductor market in the late 90s, when they were all sort of $1, $2, $3 billion companies, very profitable, very small, very boring, to now very profitable, very big, very boring companies in the $100 million, $150 million range in some cases. And that's not a coincidence. All of these companies have gone from 1 to $100 billion over 20 years because they're in exactly the right bit of the market. I would take that 1 to 100, not being entirely literally, but that sort of order of magnitude change, because they're in exactly the right place in the market. This key element of translating the real world for the computer so it can understand it. So that's one big group. I suppose another big group with semiconductor equipment companies, so the companies that make the equipment to make the semiconductors. So if you think about that, software and semiconductors are eating the world. They're basically eating the hardware industry. So if you're Dell or Hewlett Packard or EMC, or the box makers, you don't really add any value now. You just put your brand on a box that's made by someone else using components from someone else again. So the software and the semiconductor companies are eating the hardware industry. The hardware industry, or tech as a whole, is eating more of the world, direct connection, that sort of stuff. And then within the semiconductor industry, the semiconductor equipment companies are eating more and more of the value from the semiconductor equipment companies are eating more of the value of the semiconductor industry, because the vital intellectual property of how to make a semiconductor is owned almost entirely now by the equipment companies. So the equipment companies are eating a bigger share of semiconductors, which are eating a bigger share of technology, which is eating a bigger share of the world. And that puts semiconductor equipment on a very, very strong trend indeed, which is why we have 15, 17% of the fund invested in 5 companies in that space. So it's an oligopoly. It's very clear who's getting the value, and that's not going to change anytime soon. So that'd be another category. Those are the 2 clearest ones I would have thought. There are some software companies, slightly more diverse, but in general, if your business is moving or has already moved to the cloud from an on-premise or license fee billing basis, that makes your business model much more attractive. It's a painful process. You probably don't want to own the beginning of the process, but you might want to own the end of it. So I think thinking about our software companies, they're probably almost all on the cloud in terms of delivery on demand. But what we don't want to own are the ones that are located within, say, 50 miles of San Francisco, because then all the value is going to the engineers and none of it is going to the outside shareholders, us, our clients. Let's see, what else do we have? So we got a couple of disruptors. So having said all these rude things about disruptors, we do own Etsy and Mercado Libre, and they're both, I mean, you could argue they're enablers, but I'm not going to try. They're disruptors. You know, they're destroying the livelihoods of companies around them. But what we like about them is they are phenomenally profitable businesses. They're very, very well run. They've got amazing defensive niches, and they're making a lot of money, and all that money, or almost all that money, belongs to outside investors. So we just love those 2 businesses. Etsy's had a difficult year, but it's bouncing back, so I think it'll do okay. So that's that's sort of e-commerce, I suppose. Yeah. Most of the other ones are probably sort of stock-specific stories rather than groups, I would have thought.
Well, we have a question regarding more stock-specific. So,
yes.
Just to let everyone know, so we will wrap things up in about 10 minutes. So we'll finish on 11 CET. But just a question about Epam Systems, William. So yeah. Epam's, a very interesting company mentioned in your presentation, and they were the ones that scaled up Fortnite to 350 million players. So hopefully they're all these metaverses that are going to be they might be part of that. But anything exciting happening with Epam?
Ukraine might be invaded. That's a bit of a downer. So Epam is originally a Ukrainian company. So it's listed in the US. It's a true global company, but it does have a lot of research or engineering done in Ukraine. It has, I think, 6 data centers in Ukraine, one of them in the east. All the rest in the west. It's mainly occupied around Kiev. It's got a bit in Belarus as well, but really that's its history. And now it's a global player. So there's stuff everywhere. It's very well run. In 2014, showing my age there, 2014, when Ukraine was last pestered by Russia and lost a bit of its territory, there was a panic about Epam then as well, and it went down. And then it went back up again because it had absolutely no effect on the fundamentals whatsoever, unless there's a full-blown invasion of Ukraine, which I personally, touch wood, think is extremely unlikely. I think if that was Putin's intention, he wouldn't have let us see his army gathering. He would just have done it. Why would he let them sit there for 2 months? And besides, an army of 100,000 is not enough to conquer and occupy a country the size of Ukraine. So that just doesn't scale right, in my view. But anyway, so assuming there isn't a full-scale invasion of Ukraine, it probably has very little direct impact on Epam's business, but it has a huge impact on sentiment. And it's been the main factor dragging the stock price down from, it was still just around $700 at the beginning of the year. It got down to $430, I think, a few days ago. So that's a massive fall, not quite half, getting on that way. It's bounced back a bit from that, but it's still only sort of 475 or something. It's always annoying when the stock you use in your presentation as the favorite stock pick falls by almost a half, but there's a pretty clear reason why it's happening. And if Ukraine pressure comes off, so if it comes to the day when everyone thinks, actually, nah, we're fine, it's not going to invade, then I think Epam bounces straight back up to 600. Whether it goes to 700, I don't know, but it probably goes back up to 600 fairly fast. So that looks interesting. Sort of something you could deduce one might want to be doing with that information. And this is not, of course, a stock recommendation. I can't do that to individual investors. And I can't also tell you what my fund might be doing. But that's the calculation. When do you get to the point where the chances are there isn't going to be an invasion? And is there still $150 upside to the old stock price, $250 upside? Then probably there's something you need to do at that point.
So it's on the subject of Ukraine then. So, you know, I saw Biden announcing that he was putting a blockade on semiconductors shipped into Russia. And does that have a big impact? Are Russia a big buyer? You know, just sort of shows that how important they are as for their industry, or for their country.
Yeah, potentially. I think probably not as much as China, because it's, I mean, Chinese industry is, you know, the world's biggest user of leading edge technology in terms of manufacturing stuff for the rest of the world. So US designed and built chips, and chips built using technology from the US in Taiwan and South Korea going into China drive the Chinese economy. So if you cut off the supply, which is basically what Donald Trump was doing, that is really pretty unpleasant if you're a Chinese tech company such as Huawei, which is, you know, basically had to develop a new business model. It just couldn't do what it did before. That's not so much the case with Russia, because Russia is a very old-fashioned economy. It's driven by mining and oil and gas. And while it's quite useful to have technology for those things, you can probably get away with, you know, a spanner and a crank and a lot of elbow grease. The Russian military presumably uses a lot of technology. I mean, they've got some very, very sophisticated stuff in there, but the volumes of technology you need for that are not huge. My guess is they've stockpiled everything they think they can possibly want to use for the next few years. And that sort of chip, so aerospace and defense and space type stuff, you know, they tend to have very, very durable chips. You know, they're designed to survive pretty much anything, so they don't tend to need replacing too much. So the Russian military may be a bit worried, but my guess is they've stockpiled everything they want, and it has less impact on the economy in general because it's an old economy rather than a new economy. But it's probably not going to be much fun. I think the main impact you could have is that if every Russian oligarch can't get the latest iPhone without traveling to the, you know, to Western Europe, where they'll be arrested or something because they're being travel banned or whatever it is, that could piss people off a bit. But I'm not sure it would piss them off enough to have a revolution. So it's just probably one of those annoying things rather than a catastrophic thing. Cutting China off from all semiconductors, that would be potentially catastrophic. That's right. That's the biggest single weapon that the West has against China.
Great. So if there's any other questions, please put them out. But just more on a summary now. So you know, from the start of this, we talk about, you know, down markets. You know, do we know this then? Who knows? You know, the positive trend for BlueBox. You know, you talked about previously the cycle. There was a tailwind. So as of last year, you had a tailwind behind the fund. So, you know, this should be a market where you're outperforming. Is that still the case? Are we still, you know, going up to the top of that line where mega caps will outperform, or is it now time for mega caps to outperform and, you know, your stocks to?
That's an interesting one, actually, because the mega caps thing hasn't turned out as I thought it would. So let's go and have a look at the mega cap chart. So if we can find the right one. So hopefully, oh, that was it. So what we have here are comparing two different versions of the same index. So the S&P Tech again, and it's the equal weighted, the one we saw just now, compared to the market cap weighted version of that index. So when the line is going down, the mega caps are outperforming the rest of tech. When the line is going up, the mega caps are getting left behind by the rest of tech. And normally, it sort of looks like this period, 2013 to 2019, no particular trend. You'll get a couple of years down, a year up, a couple of years down, a year up. When it's going down, it's a little bit harder for us to outperform because we always have less in the mega cap area than our competitors and than the benchmark does. And when it's going up, it's wonderful. We tend to outperform when that's going on. So for example, 2019, we underperformed the index by a few percent. We still beat 75% of other tech funds, but we did underperform the index because the mega caps outperformed every month apart from January. That's quite a hard environment for us. Then you get a crisis. So the exceptions are the financial crisis, Euro crisis, and the COVID crisis. And when you get a crisis, my apologies for the dogs in the background, when you get a crisis, the line plunges to a completely new level. And that's because people hide in the mega caps. So this is the bottom of the market, COVID crisis, March 2020. And people were hiding in the very highest quality companies. And of course, actually that suits us as well, because one of the places they're hiding is in companies with no debt and lots of free cash flow. And that's what we own. So we did quite well, surprisingly, in that period there, despite the light going down. And then we managed to get all our money back into the market, what turned out to be the right moment. And the market, the mega caps continue to outperform, even though actually the market is bouncing at that point. It's being led by the mega caps until the day comes where everybody says, actually, these tech companies, they're not going out of business, the small ones, they're all having a rather good time. We don't need to hide in the mega caps. We can get back into those more interesting large cap, mid cap names. So then suddenly the mega caps just stop going up. And if you look at the charts of all the world's mega caps, with the exception of just 2 of them, they all stopped going up on the 1st of September. It's quite striking. They all went down or flat from that point on, as all the money was shifted back into the more interesting mid cap, large cap names. And so the line shoots up as the mega caps stand still and everything else goes up very fast. And normally that then goes all the way back up to the top of the range. But this time it didn't, it got stuck. So this point in, again, sort of February, March of 2021, so first quarter of 2021, the market slightly changed direction and decided, actually, we are more worried about profitless disruptors, profitless business models than we are about, getting left behind by the market. So actually, maybe these mega caps aren't so bad because they're very profitable, they're very well established, they're still growing, and people write about them a lot in the newspaper, so they must be exciting. And so I think maybe that's what's happened, and the line's gone back down again. So actually for 2021, this was a headwind. So this should have hurt us in relative performance terms. It didn't, luckily, we outperformed still, but that has surprised me. But at some point, I think this line goes back up. I just don't know when it's going to happen. And when it does, that's fantastic. So I mean, this period here was just amazing for our performance. And that was the best period of relative performance for a fund I've ever seen, to be honest. But luckily that didn't hurt, possibly surprisingly. But at some point it'll go back up, and that's just a big tailwind for us for a year or two, potentially.
So it's a couple more questions towards the end, William. So which sectors do you think experience the most decline this period? Where do you see markets falling to? And your views on inflation by the end of the year? So hopefully you can see those as well. So I read them out too quickly. Decline.
So my hope, I'm biased. My hope is that the profitless companies see the biggest decline, because theoretically, in my view, they're worth nothing. So there's nothing to stop them falling further. But at some point, that'll be wrong, and they'll start going back up again, and everyone will get excited about it. Probably a different group of companies, but they'll get excited about them. There will, at some point, be a semiconductor downturn. So everybody's been worried about a semiconductor downturn this quarter for almost a year now, because that's the way that people do with semis. They always, if they go up, they always assume that's the last quarter we've seen the peak and we're about to see the downturn, and they haven't realized just how bad the shortage is. So I don't personally think that's going to happen this year. Doesn't mean to say we'll stay at 40% weight semis through this year. At some point this year, we'll start taking that weight down. We'll still have more than anybody else in the market, but we don't want to be at full weight when the cycle's getting a bit old. Where do we see markets falling to? I'd love to tell you, but I have no idea, to be honest. As I said to, I think it was Michelle's question earlier on, we've probably seen the worst, but who knows? I don't try and time markets. Inflation. Well, personally, I think inflation turns out to be more transitory than people think. Because if you have if the oil price jumps by 10%, that has basically a 10% impact on your inflation figures for the next 12 months. That's just how the arithmetic works. And we had a huge jump in all sorts of things a few months ago. And until we lap that, that inflationary pressure from those factors will still remain in the numbers. And I think when we start lapping that stuff, all those numbers will come down. I mean, there clearly are lots of shortages, and that's pushing stuff up, and wage pressure is going up, which is a good thing, but hopefully that draws more people back into the market. In general, stock markets keep going up as long as people keep being added to the workforce. And we are at present about still, even though we have a big recovery from the COVID crisis, we're still about at the lows of previous cycles. So in theory, there are millions and millions of people in the US who could return to work, and probably will over the next few years. And as long as they do return to work, stock markets tend to keep going up. So that's the most consistent indicator of when a market is about to roll over, is if that total employment number, so it's not the unemployment, this is the employment, how many people there are in employment. When that number rolls over, then markets tend to roll over. And at the moment, we're at the lows for previous cycles, nowhere near the high. Maybe we can't wheedle all those people out of their bedrooms. Maybe they're just addicted to Call of Duty and they've been given enough money during COVID to stay in there for the rest of their lives, but I doubt it. So at some point, people are going to have to come out and start working again. And that's good for markets. I see a question about Fundsmith at the end. So it's not a tech fund, so I haven't looked at it closely, but my understanding is that their approach sounds very similar to ours. So that's one of the things that Jupiter has said to us many times, that we sound like Fundsmith, but applied to the tech sector. They like that. They're very big investors in Fundsmith. I think Terry Smith says some very sensible things. I think technology is a weak area for him, but I don't know. I've never met him, and as I said, I haven't analysed the fund in general. But I'm told there's substantial parallels between what we do and what they do, and there is no one else in the tech sector who does anything even slightly like that, which is why Jupiter's invested with us.
I do see in the top holdings is Meta's in there, so slight mix of probably yours and the other side. And we've had this conversation.
Well, Meta's an amazing business. I mean, it's phenomenally profitable. I can't complain about it as a business. So I'm not saying things like Google and Facebook and stuff, just because you don't own them doesn't mean they're not good businesses. But will it be a better business? Will Facebook or Meta be a better business in 5 years than it is today? And my guess is it isn't. And if it isn't, it's underperformed tech. It might underperform the broader market. So it might help Terry Smith, but it wouldn't help me because we've got different benchmarks.
Yeah, and we've had this conversation many times with investors and that, and there's an argument of BlueBox being in a portfolio, and an example of BlackRock fund, because they're very in terms of
this is totally complementary funds. And Tony Kim, who runs the BlackRock fund, is a brilliant fund manager. I mean, he's one of the best fund managers in the world. If he wasn't as good, I'd still be at BlackRock. So, if you want someone to pick you disruptive stocks and get out before it's too late, Tony is your man. There is no one better in the world than doing it. So those are totally complementary funds. They do different things against the same benchmark. But he's getting a bit stretched because he's got 3 different strategies now. So I've got to put a little bit of a negative in there for him. He's got different strategies and he's running, $30 billion or something. So, and it's still a tiny team. They're very good, but still a tiny team, and they're doing quite a lot now.
So we will wrap this up, William. So we're just going past 11 now. But just for I think with BlueBox has grown. Are you growing the team? Are there other funds in the pipeline? I know you're
maybe
operational side. I saw some hires there. New head of funds and things like this, or fund relations. If you just give us a little overview.
Yeah, so the investment team for the tech fund is not changing. So there's just 2 of us. That's enough. We're not going to add any headcount. We don't need any more. Any more would be a distraction. It would reduce performance. So we're not going to change the team for the investment side. So it's 2 of us, and there always will be for this fund. We are adding people on the admin side because life is getting more and more complicated, and there's money coming in from all sorts of different directions, and some of it takes a lot of tracking down. We do our best, so we want everyone to be rewarded for the efforts they make and make sure they're in the right classes and all that sort of stuff. That takes time. So we have been adding headcount. We are in the process of finding someone to do sort of sales, product specialist, marketing, distribution, supremo. That's a lot of hats for one person, but hopefully we can get someone in place to do that fairly soon. One fund we are publicly adding is that we are launching a Sharia version of the technology fund. So at BlackRock and its predecessors, Merrill and Mercury, I ran the global Islamic equity portfolios. It's an unusual combination to run a global equity, a global tech and global Islamic funds, and they are very easy to combine. So we are launching that product fairly soon. So it'll look very similar to ours, to the existing fund, but with about 10% of the names taken out because they failed Islamic screening. But actually the performance is very slightly better, which doesn't surprise me at all. Islamic benchmarks are amazing. And then we may or may not be launching a completely unrelated strategy later on this year, but I can't tell you anything about that. But it wouldn't be run by me.
Very nice. Yeah, no, so great. Right. Well, if there isn't any other questions, this has been recorded, so we will send this out, to everyone afterwards to listen through. If anyone, didn't get a chance to listen, please forward it on. So yeah, thank you very much, William. If you do have any questions that you didn't get to ask, or things do pop up, just shoot William an email. He loves answering these things, so just copy me in, and we'll get back to you as soon as possible. Thank you much. Thank you very much, everyone.
Thanks, everyone. That's a nice little message from Trevor at the end. Great. Okay. Bye,
Yeah.
everyone. Thanks for taking part.
Cheers, William.
Bye.